Congrats on getting beyond $1 million. What got you here won't always get you there. This is a podcast for entrepreneurs who want to reach beyond their 7-figure business and scale to 8, 9, and even 10 figures. I'm Brad Weimert, and as the founder of Easy Pay Direct, I have had the privilege to work with more than 30,000 businesses, allowing me to see the data behind what some of the most successful companies on the planet are doing differently. Join me each week as I dig in with experts in sales, marketing, operations, technology, and wealth building. And you'll learn some of the specific tools, tactics, and strategies that are working today in those multi-million, 8, 9, and 10-figure businesses. Life can get exciting beyond $1 million. Garrett Gunderson.
What's up?
Thanks for coming to hang out, man.
It's good to hang, man.
It is good to hang, dude.
I still smoke my tobacco pipe you gave me.
Good.
Blue and black. It's pretty cool.
I love it.
Yeah.
Well, yeah.
I usually take a picture when I'm smoking it and send it to you so you know.
I think that's fantastic. That's fantastic.
Yeah.
I think it's actually,
it's on display at all times.
It's a page in the John Ruhlin playbook. Like, give somebody a gift and then show the world 8 times over.
Yeah.
I love John.
I just sent John a gift that breaks all of his gifting rules.
Oh, nice.
Because he was
like a piece of cheese.
He's like, hey, like, how do you get a hold of elk meat? I'm like, well, I go elk hunting. He's like, can I buy it from you? I'm like, by the time I pay for the hunt, that's like $300 a pound. It's like the worst deal ever of elk, like to get elk meat. But I sent him a whole bunch of it.
Yeah, that's good.
Because he basically made sure St. Louis was sold out with my comedy tour. And as you know, I'm very fickle when it comes to. I'm super easy to win over if you put people in seats at my comedy shows.
That's
I'm like,
awesome.
Yeah,
but it does break all his rules.
Yeah.
It's perishable. It's consumable. It's gone right away.
Yeah. I could send knives to cut it up, but he has every knife that's ever been created. So there's nothing to do. Yeah.
As do I.
Me too.
Yeah. Well, we met, John and I, in Cutco. So we grew up in the same, like within 6 months together, and did not get along.
Really?
No. So we've sort of come to center over the years, but
because we all hung out at the cabin together.
Oh yeah. And like now we're like very, very close friends, but he was, he grew up very, very, very straight-laced religious person. And I grew up completely wild, got arrested
like Mohawk
11
kind
times.
Of guy.
Yeah, didn't quite then, but got arrested a lot in high school. And then over the years, we sort of,
found some common ground somewhere.
As life goes on, I feel like rigidity collapses.
Yeah.
Yeah. I mean, for a lot of people. Yeah, you sort of start to see that things can't be black and white in perpetuity. Right? There's too much gray in the world and there are too many exceptions to the rule to look at it that rigidly.
Yeah. Agreed.
So yeah. Anyway, I want to talk to you about money. I know nobody talks to you about money ever.
No.
But for starters, so you're on right now, you've abandoned the rest of your lifestyle and decided you're just going to be the funny man and tell jokes on stage all the time.
Which is like a short amount of time that's super fun, and then it's promotion in between. So,
which, by the way, you've been doing your whole life, or adult life, right? So you're good at that side of it, which helps the whole endeavor. But I think
as a rookie comedian doing 15 cities,
crazy.
We've sold out, 11 of them or 12 of them already. I just need to sell out 2 more.
Yeah. Yep.
Got to work on that sometime soon.
I feel like that's going to happen.
Yeah, Miami and Philly. Those are the last 2 I gotta fill.
I feel like I don't know who's the lever in Miami.
I've got a few good connections. I think it's gonna happen. Philly, I'm a little bit more nervous about.
I feel like
trying to get people to like come over from New York and from New Jersey to Philly.
Yeah, Philly in the winter too.
Yeah,
trying to get people outside in the winter.
We'll be indoors.
Yes,
it's fine.
That's true.
You need to laugh if you live in Philly. So
that's true too. That's true too. This is probably gonna be another booze situation in Philly
for sure. Like Dallas, a lot of booze, but one of my better sets.
Yeah.
Boston, a lot of booze, my worst set.
Yeah.
It was just
they're just angry. There's angry people.
And I was making fun of Boston. When I made fun of California, they hysterically laughed and thought it was great. When I made fun of Boston, they took it really personal.
Yeah, that doesn't really shock me, actually.
Or I made fun of DC. Nobody cared because nobody's actually from DC.
That's fair too.
They're just like, and
whatever.
Yeah, whatever.
Well, this will tie in well because all of this is tied directly to the capacity to be able to do it at this point in your life. And it doesn't have to be, right? Some people when they're younger pursue their passions and they forego financial stability. You pursued financial stability I think found this, but why don't you give a little backdrop on your business upbringing and kind of what took you to here?
At 15, I started a car detailing business.
Nice.
Yeah.
Lucrative?
I won $500 for taking third place when I was 15 years old in the Rural Young Entrepreneur Competition, which I'd only made like $600 of net income at the time.
Nice.
So I was like, cool, I can give a speech and win $500 or wash cars and make $600.
Oh, wow.
So next year I won first place, came with $1,000, and I won it for the state, which came with $5,000, which was basically what I had made in the business at that point, and just wanted to invest that money. In the pursuit of trying to invest that, being under 18, I started talking to people. When I was finally 18, I got offered an internship. I started one when I was 19 in the financial service business. Sounds cool. It was peddling mutual funds and life insurance to friends and family.
Sure.
It was more of like a sales internship than a financial internship, but it still led me down the road of being able to interview a lot of people and learn a lot from some good financial minds. And then when I graduated, I just created my own business in the financial space and realized early that if people don't have the right mindset, it didn't really matter. And so I gave up selling insurance and funds to really focus on, I had a radio show back, it was radio, not even podcast back then, you know, and started a membership back in the day for $20 a month called the Producer Revolution. It was about mindset, perspective, but we also had the functionality of the financial firm behind it and built an entire kind of like comprehensive financial team. And then created a program called Freedom Fast Track after a couple of my partners died in a plane crash. And would you laugh as I say that just because I'm matter of fact about it or what?
I just, it's like, there's a lot condensed there. There's like, 18 different stories to go down.
Yeah.
And that's the summary. And then you kind of just
drop
the,
And so then got to the point where I was done being in a service-based business as far as managing it and implementing everything. And my partners were a lot better at it. So I sold it to them and focused on comedy because I want to reach the masses. Like I can help really wealthy people out and it's kind of fulfilling, but I'd rather tell a bunch of jokes to people that would never handle their finances and reach people that are really struggling. Because I think that the middle class is in a world of hurt right now and it's just going to get really, really bad for them. And hopefully I can help them out.
Yeah. Yeah, that's interesting. You said something initially, which caught me, which was, it was the pursuit of money, but it was focused on speaking, right? So you transitioned from running a business to speaking.
Yeah, I had fun speaking. Scared when I was 15.
Sure.
Like really scared. I had to go in front of this panel of judges. And crazy enough, I told a joke. And then they laughed. And it was like, oh, damn, that was probably where the comedy began a little bit more. But I was thinking, oh my God, it's like I had employees because I blew out my knee. And so I had 2 employees that helped detail cars on my knee. So I had employees while I was in high school. But I mean, it was still like, that was blue collar work, washing and detailing and waxing cars and all that. But I learned some basics in marketing, but I learned a lot more in speaking. And so when I got into financial services, I learned to do the one-to-many thing pretty early. Like in 2002, I was already doing dinner talks as a young kid. Tried to look more professional than I was. Had fake glasses.
Nice.
Yeah, and I would sometimes even wear these fake glasses so I would look more, wore suits. I haven't worn a suit in a long time, but I was trying to have the appearance and I tried to sound smarter than I was. I tried to over talk financial terminology so they would be like, this guy's really smart and hand me their money. And I was really good at that, but it wasn't really helpful for them. So that's when everything kind of changed in 2005. Started the radio show, started writing books, started focusing on education and doing events, and a lot more rewarding, a lot harder. Yeah. I was making a lot of money selling life insurance and funds and stuff like that. And I gave up those licenses and those renewals in order to kind of shift into the education space. Consulting. I mean, it's easier if someone just puts their money in a crappy 401k and I get paid on it no matter what happens, than actually having someone write me a check for performance and helping them save tax and interest and, restructure insurances and save money. It's just a lot more labor.
Yeah. You have a joke.
Do I have one? Or I have one?
I just wanted to let that hang for a minute. You have a lot of jokes. You have a joke specifically about 401ks in the financial market and giving them your money. Does that trigger that for you? Do you know what joke it is?
Well, I have several 401k jokes. One is, a lot of people put their money in a 401k, but they don't realize there's a big difference between saving tax and delaying tax. And when they go to pull their money out of their 401k, it's going to look like a 201k because they have to pay that tax. And I'm like, plus you're waiting to pay it when you're older and crankier.
Yeah, no, that's fair.
But I'm like, why do I want to delay all my money till I can finally afford to enjoy life when I'm too old to enjoy it? Yeah. I'm not going to go like jet skiing when I'm 85. Yeah. I'm not going to get crunk up in the club when I'm 85 and I might break a hip. Yeah. I mean, hell, the only thing that happens when you're 85 is you wake up. Some days you wish that wouldn't happen.
Yeah, fair enough. Fair enough.
So yeah, that's a little bit of the material. I don't know if that's the 401k joke.
No, it wasn't. It wasn't 401k. It's like it was giving your money to a financial advisor and asking for honest advice is like giving your money to a stripper. Yeah. Oh, the stripper one. Yeah. It's like asking a stripper if you're handsome. Right. Well, you are while you're paying me. Right. Exactly. Right. Exactly. Yeah. So that for me, one of the things that this is going to go contrary to wanting to help the masses, I'm afraid, but in the nature of working with business owners that are past $1 million, that are moving into, scale, that are looking at 8, 9, which are actually the easiest people to help. 10 figures. Well, that's what I've been doing for a long time. Yeah. Because when you have money, you have different problems. Right. You're paying too much in tax. That's the number one complaint I would think that most business owners making 7 figures of revenue and above, they're just overpaying tax because they're busy building their business and not paying attention to their, they're at least overpaying $206,000 just to throw a number out there. Well, so this is one of the questions that gets asked a lot, or I think sometimes doesn't get asked, but really needs to be focused on is at what point, because like you look at what point does it matter? At what point should you really shift your focus from, and not that you should ever ignore revenue generation, like obviously that's the game, right? But at what point does it become really relevant where you're like, oh man, my personal income is X. Now I have a new set of things that I can deploy. I have a new set of things that I can attack. Look, there's so much. Once you have $660,000 of net income, you have game-changing tax strategies available to you. Like big dollar tax strategies, not like a couple tax deductions here. They're like major advantages. And most people they don't deal with it because their tax person's a historian, just says, oh, you had a good year, Brad. Here's what you owe. That's not helpful, right? And at a certain point, which corporation you choose makes a big difference. And even if you have a tax attorney that can help you out with major things, like we were talking just the other day in a group, and a bunch of people were taking notes on a bunch of these tax strategies, like tax arbitrage, or like buying art and then donating that later on, or I don't know, there's just so many things that could be done. And most people are just deferring their taxes, putting in a retirement plan. Well, that's not good enough because the government's $30 trillion in debt. They're going to raise taxes. So you need permanent tax solutions and strategies. Yeah. And they're like the biggest cost you have, more than any of your high paid employees even. So why not just address that? Because once you address it, you'll have trailing effects for years to come. Even when there's tax law changes, you might have to make small adaptations. And it's something that might take you 20 minutes to an hour to figure out and a few $1,000s to implement that could be saving you 5 or 6 figures. Mm-hmm. Yeah. Well, so 660 is the number. That's like the big number. Like you could still save under that, but if you're at that number, you get a whole different world of tax strategy. Yeah. I think that's a really important, figure for people to grab, because for me, I think that there is tremendous freedom in structure. And there are a lot of people that buck structure. But for me, if I can find structure, I know then, okay, these are just the rules. And then I can go do whatever I want because I know the rules. I don't have to stress it. And so, hey, 660 is the number, and oh man, I should pay attention, right? And I remember actually talking to a tax strategist when I was making like $400,000 a year and thinking I should be able to do something. Like I have a big tax bill, and them being like, come back to me later. Like keep increasing your income. Yeah. You have an income problem. Yeah. Yeah. When you solve that, you'll then have a tax problem, and that'll be a good problem to solve at that point. Yeah. Exactly. I mean, and there's really just like the tactical pieces is there's 4 main things to focus on. Can you take your active income and make it more passive for tax purposes? Because that's going to save you a minimum of 3.8%, but as much as 15.3% just in how you classify your income. Can you turn ordinary income into capital gains? At this time, that could cut it in half. That could change with the tax law changes.
can you find things that are tax-free that would normally be taxable, which if you have any highly appreciated assets, that's possible with charitable trusts and donor advised funds and, crazy strategies inside of like, private placement life insurance, which again, the more wealth you have, the more these become available. And then the last one's like tax arbitrage. You spend $1, you get more than $1 back, where most people are spending $1 to save 37 cents. Well, you just lost, 60 plus cents if you weren't going to buy that anyway, if it didn't make economic sense. So, so those are reclassification strategies that usually come from attorneys more so than CPAs.
Yeah. Well, that was the answer to 2 questions.
Oh, there we go.
Which is great. Which is, one is kind of what is the overarching strategy that you start with, right? Where do you start? And
my start is 3 to 4 people on your team. First, if you're a bigger business, you have to have good bookkeeping, controller, or CFO, depending on the size of business. CFO is going to do more pro formas. They're going to manage more like of the entire cash flow in a business. The controller is just going to handle payroll. But either way, if you don't have timely data, you're going to overpay tax. Most people don't have timely data. They try to make a strategy for 2021 and 2022, and now they're just back in a deferral.
Or in November or December.
Right, which is really late because especially right now, like if we're talking, in 2021 right now, everyone's trying to move that's really wealthy their money through trusts right now to avoid the increased taxes that are coming. So attorneys are extraordinarily busy right now. And if you're not doing something, you're pretty late in the game. Mm-hmm. Now you might be able to convince someone if you have a friend or have a favor. Like I've been able to do that for clients just because of the number of referrals that I send to these people. But the attorneys still get annoyed with me. So it's important to have that. Then the second thing is having a tax strategist that you meet every quarter with and talk about how do you maximize your deductions. Now, deductions are going to be limited. Unless you're like a real estate professional, deductions, you don't want to destroy all income in the business to a point where you can't get loans and where, but they are helpful. Then the third thing is that, tax attorney or a corporate attorney that's going to help you reclassify income. And then if you own commercial property, it would be getting an engineer that can do some cost segregation, which allows you to accelerate depreciation on real estate. But it's really the 3 main people on the team and going back the last 3 years to see if you overpaid taxes. Mm. They changed rules in COVID where you could go back 5 years and see if there was ways to mix and match your operating losses. So they used to cap operating losses at 80% for taxes, but they said, okay, we'll make it 100%. And you could take a year where you had high income and match it to a year where you had high expense and get that reassessed to get a refund. Or people that have a bunch of technology that they've developed, they can get R&D credits that they had missed 3 years previous. And it didn't matter what they paid. It's the time that was spent, and they get credits for the time spent for them and their team. So those are things you might be able to go back and get back. Most of the time, you can't go back and get things that you missed. If it was like, oh, I could have paid my kids. Well, you didn't.
Right.
Or, but I've also seen people make mistakes and they're paying, on 1099 income, the 3.8%, that's kind of the minimum tax you pay on W-2, even when you've maxed out FICA FUTA. It's like, oh, guess what? We get to go back and get that money back. And it's not a red flag. It's not an issue. It's just your accountant messed up. One of our friends here in Austin overpaid that by $300,000. And we found it. And he's like, am I going to get in trouble here? I'm like, why? You overpaid your tax because your accountant screwed up. Like your accountant should get in trouble, but the IRS doesn't care.
Right.
Because this is rightfully your money that wasn't reported properly.
Yeah. I feel like there's this sense of just general fear with the IRS of like, I just don't want to, I don't want to disturb the beast, right?
Yeah, and there are true red flags. Mm-hmm. So I don't do anything internationally. There are probably legal things you can do internationally, but you will garner more attention. Mm-hmm. The only international strategy I would recommend that I feel completely comfortable with is if you're doing business internationally and you use an international sales corporation to reappropriate the money back in the United States, they'll let you do it capital gains. That's a government structure. They're happy because they want the money back here and not keeping it internationally. That's fine. But when you start getting into offshore trusts that might save taxes, a Malta trust, for example, or a Malta pension can avoid taxes. But at the same time, can that really hold up long term? Will it hold up long term? I don't really know. And I don't want to take on that risk. So there's a lot of kind of things promoted that I would say are borderline, but there's plenty of legal and ethical things that you don't have to worry about at all. I've been audited twice. No concern. I didn't go to the audits. I knew I wasn't going to owe anything from the audits because I've done nothing that isn't documented and well above board. Like, even the art donations that I've done, or the only two things I've done that increase my audit risk is I did a captive insurance agency, which for wealthier businesses.
I want to drill into that.
Yeah, it's an 831B.
But I want to talk before we do that, because like that's like a independent specific strategy, right?
And it does increase your risk, but the main reason is because most people don't do it right.
Right.
They abuse the system.
Yeah.
And therefore they draw attention to them.
So that goes back to the original question, right? Which is, so you start earning, you hit the 660 a year in net income, or whatever beyond, right? Anything beyond that. And it's this trigger, and it should be a trigger internally of, I need to have a different set of strategies, right? Once you're beyond that point, you need a different set of strategies. The first thing that you said was you need a team to help advise this.
Right.
So one of the things that is really common for brand new people in business is, and even people that are doing decent volume, they say, oh, you should have a good CPA. And what you said was, what role should the CPA play? And does it matter if you have a particularly good CPA?
I want the CPA to be a tax strategist instead of a historian. I want them to look and say, can we maximize tax deductions? Like, here was a big thing my CPA did in the last few years. They learned when Trump changed the tax laws about section 199A, which 199A was, if you have a lot of payroll, you can get this payroll deduction that would take your tax from like 37.5 down to 22%. But
huge deal.
It was hard for early on for a lot of people to understand. But it saved me a boatload of money. It was absolutely part of the new tax code. It was completely above board. And if you missed out on it, you way overpaid taxes. Mm-hmm. The CPA was really responsible for that for me.
But in addition, you have not just the CPA, you also have
the attorneys, right? Mm-hmm. And so there could be a corporate attorney for someone who's maybe just starting out, because the corporation you choose will impact your taxation. And if you are doing well and you don't have a entity because your accountant says you didn't need one, your accountant's not an attorney. And you should fire them for giving advice that's outside of their lane. And first off, just from a liability standpoint, if you're a sole proprietor, you have unlimited liability. If you're a corporation, you've now limited your liability. Just from an asset protection, that makes sense.
Right.
But from a taxation standpoint, it makes sense. It's just that CPAs a lot of times don't want to take the extra step. And so they just tell you not to worry about it. Well, I had this chiropractor that told me he had the best CPA in the world, and he lived in nowhere, Illinois. So I didn't believe that it was the best CPA in the world. And I was glad I didn't believe it, because we ended up finding $100,000 and some because he wasn't cost segregation with his building, and he wasn't an S corp. He was just straight up sole proprietor, which saved him $10,000 a year just with that one simple thing. And I'm trying to think what the other $10,000 a month was like, but it was a bunch of money. And then he got audited 4.5 years later, worried. We saved him $5,000 in the audit, because we were still being relatively conservative, because he was worried. I don't want anyone losing sleep about their tax structure. Yeah. But I told him, hey, if we save you tax in the audit, you have to take me to a football game. You have to buy me a nice dinner. And we did. Yeah. And we did.
Okay. So CPA, you said tax attorneys and bunched everything into that bucket. Are those the two people on the team?
Those are the main people that are your outside people. Then you just have to have like a bookkeeper, or whether they're part-time or full-time, or a controller if you're a bigger entity, or even bigger, a CFO.
So I know that we have a mutual friend that I've talked to you before about this, and there are other people that fit in this space that aren't CPAs. They're not tax attorneys, but they fit this bucket of a wealth advisor, right? And they specifically work with tax strategies for wealthy people. Is that a third person on the team, or a fourth, or do you not have them in the mix? Does your CPA fill that role?
Well, I don't know. I kind of fulfill that role, on my, and I have other entrepreneur-based kind of wealth strategists that we refer to that are really good with that, because you kind of need that entrepreneurial thinker. Yeah. I once had a tax attorney and said, hey, you're making a lot of money. You just got to be used to paying a lot of tax. And by the end of the call, we'd saved two major things with tax. And I was like, I guess they no longer want to be part of the team for even, putting their foot in the mouth. Because I don't want to do anything that's going to make me owe money afterwards that I'm going to lose sleep about. Like I sound like I'm aggressive. I'm not aggressive, because I do nothing. It took me 17 years to finally go, I think I can do a captive, because I know how to navigate the pitfalls.
Mm-hmm. Yeah. There's a mountain climber, Ed Viesters, who is one of the few people who has climbed the highest peak on every continent with no oxygen. And he is a relatively straight-laced mountain climber. And he got interviewed years ago, and he wrote a book about it where he brings this up. But he got interviewed years ago, and the person that interviewed him wrote this piece and said, this guy is playing Russian roulette. Statistically, there is this likelihood of dying every time you climb a mountain. The more you climb the mountain, the more that risk increases. And Ed said, no. The more I climb the mountain, the more experienced I am in the process, the less risk I have in the process. Those stats don't apply to me. And what I heard was, if I understand the strategy and there's case law behind it and I'm aware of it, the strategy is totally safe. Just because you're ignorant to the process doesn't mean that it's not safe. That it's risky.
like I had someone was a client once call and say, hey, I'm gonna do a captive. I said, really? Like, tell me about it. Like, yeah, we use a Native American trust. You don't have to pay $5,000. I said, dude, no, you're not gonna do it. I'm like, absolutely not. I'm like, to set it up is a bit onerous and expensive when you do it right. And I would test firms and say, hey, I want to invest in this. And they're like, you can't invest in that in a captive. I was like, that's the right answer because I know what you can and can't invest in. It's when people abuse that system. So people skip a feasibility study or their insurability study. Like they don't know what they're actually insuring. They're just doing it for a tax evasion tactic.
Right.
That's a problem.
Yeah. So, okay. So I want to get into that specific thing, but we've got, you're making enough.
Yep.
You put the team in place that probably is going to involve a wealth strategist unless you know Garrett personally.
Right.
And then it probably still will because you're not going to hit up Garrett personally for advice all the time.
I don't give a lot of like one-on-one tax advice these days unless you're my friend. You know?
Right. So then the next step is like, this is actually a big one, which is, let's say that you're with 660, $1 million, $2 million. Let's say you're in the range of like, okay, you're making decent money. What are the initial things that you suggest moving into? What are the things that you're like, hey, almost certainly these are the first few things that you want to look at, vehicles that you want to look at?
So as far as tax vehicles?
Mm-hmm. Yeah. And obviously they'll vary, right? Yeah. The answer to that question almost universally is, well, it depends.
I have a super simple strategy for deductions that I'll give everybody. So every time I spend money, I don't ever spend it directly from the business because you want to protect your corporate veil. And a lot of people have a business credit card and then they accidentally put something that's not business related on it, which actually, if you're ever sued, could become an issue. So I put everything on a personal card and then I have the businesses reimburse. And when they reimburse, I always go, I want to write this off. But if I'm not 100% sure I can write it off, I just save it for my quarterly meeting with my tax team and say stupid things like, hey, I'm going to Italy. I want to write part of this trip off. They're like, we can't really write off. I'm like, what if I host a mastermind one of the days? What if we do our corporate compliance meetings while we're there? What if I go film where my great grandfather was from and have that be an intro to this project that we're working on? And by the end of the conversation, I'm at 55% of the trip's a write-off because now I've documented it. Now I've talked through the strategy. I mean, I bought a Can-Am, one of those like Batmobile looking things. I'm like, I want to write this off. And they're like, why would you be able, like, why would you be able to write it off? I'm like, because in the intro of my podcast, it's on there. And when guests come that are part of the podcast guests, this is part of the allure appeal to get them to come to me. So I'm travel. So we were able to write a percentage of that off. Like these are the conversations that are a little bit out there. So I don't just automatically write them off. So I just document it. Simply, I use a credit card and then I write notes next to the credit card statement. Which company needs to be reimbursed and is it deductible or not? I just put a question mark if I'm not sure. We have that quarterly meeting and find it out. There's simple things you can do like the Augusta rule. Like I use my cabin when I do immersions. Sometimes I do 10 consults a year where someone pays me $25,000 for the day. Use the cabin, get to write it off because I'm, hosting them there. They get to stay the night, all that kind of stuff. So I can write off 2 days every time I host someone. And that's a write-off for the business, but I don't have to claim it as personal income when the business pays me for the use of the property. Those are easy deductions, but the classification is the big deal. So like right now, I just filmed the comedy special. I spent a bunch of money on it. So we're looking if we can use Section 181, which would say there's film credits for doing it. And that was one of the quarterly meetings we had where I'm throwing a bunch of ideas out. And now we're analyzing if I had enough spend to get this bigger deduction. So that's not for everybody, but what you always want to ask is like, you have this studio here, right? Did you write everything off? What other things could you write off? like I want to write off clothes that I would wear when I was filming or when I was doing stage work. Like, well, you can't really do that. And I'm like, well, then why does Hollywood get to write these things off when they buy costumes for actors, even though they can wear them every day? They're like, oh, they're a production company. So I have a production company. Now I get to write a whole lot more off through the production company than I would have by not having the right entity. So I do no retirement plans. I think divide and benefit plans are the stupidest, worst idea that's ever been invented in finance, because you're going to defer your taxes into a future that is likely to be a higher tax rate. And because of inflation, it's almost certain to be a higher tax rate. And because hopefully you're an entrepreneur making more money, it's even more certain to be a higher tax rate. So don't defer taxes. I don't do SEP IRAs, 401ks, or any of that kind of stuff. If someone want to do a Roth because they can convert to a Roth, maybe. Or they want to put like crypto inside of it and it's going to grow massively, maybe. If you're willing to move to Puerto Rico, it solves a lot of problems, by the way.
Right.
You and I have not made that leap.
No.
So we have to still strategize and navigate this entire tax code here. But to me, having the team and the strategist is what matters most, because then they can look at your specific situation. Yeah. Like I mentioned R&D credits. I've mentioned net operating losses. Like those are things that you want to look at because it can make a huge difference on your taxes. Yeah.
Well, you also hit it on the head, which is you came with a bunch of ideas, right? So if you're not you and you're not thinking about it, it's important to have the right people that can give you those ideas and think about it. The other, I think that's very valuable, and I heard you told me this years ago. There's have you ever read Principles by Ray Dalio?
I mean, to say I've read it, I own it. I've flipped through it, but did I actually read it? I glanced it.
It is, I mean, top 5 books I've ever read, period. I've read it multiple times now. And one of the tenets of the book is that,
I'd have to read a book.
Well, I tried to listen to it actually, and it was so dense
that you want to read it.
I was literally stopping every 30 seconds when I was listening to it. And I was like, I can't exercise while I'm doing this. I was like, I just got to get the book. One of his tenets is, you should be careful who you listen to. And he ranks people in terms of believability. And he's like, look, if you're getting advice from 2 different people, you need to think about the believability of that person. And he said, second, and he's got a whole very well thought out approach to open-mindedness.
With amazing returns.
But one of the things that he tries to do is get believable people together in discourse. And he wants argument to have people clash.
That makes sense.
And say, hey, I've got this idea. No, I've got this idea.
Right, because otherwise, if you're only hearing the one side of the story.
Yeah, and he said, look, somebody's wrong. So we want to put that on the table with believable people so they can hash it out and I can sit and listen. So to the end of having 4 people together arguing about something or giving opinions about it, there's value in that, right? Mm-hmm. Where you can learn from it and hear it. And you being the one that's just throwing it on the table and the attorney being like, nope, that's no good. And then your CPA saying, I don't know, actually, maybe we could do that.
And I like to ask the question, in what case or in what type of entity or in what situation would someone be able to do this?
That's a great question.
And there's just times where it's like, we have a good laugh at the dumb ideas that we have on those calls. One time where I was doing a renovation of our office and my father-in-law was a general contractor. So I was like, well, maybe we could just pay him to do it. And then we're getting to a place where eventually I was like, okay, that's just not ethical to overpay him and then have him give the money back. But it's like, it's a brainstorming session.
Yeah.
We're not doing anything. So we're not getting in trouble with the IRS. We're just brainstorming and then go, yeah, that's a dumb idea. That wouldn't work. Or wait, that actually has merit, or it wouldn't work that way, but it would work this way. And if you think like an entrepreneur on those calls, that's the best thing. Question things. What's the best tax strategy you've implemented in the last 12 months for one of your clients? What's the most out of the box thing that you did that is completely legal and ethical that you were surprised that you came up with a client? What tax law changes have impacted people? And I'm just asking those kind of questions all the time. It helps that people bring me ideas all the time to be like, what do you think of this? And like someone brought me this idea for a charitable LLC, which immediately I was like, oh, that's self-dealing. Okay. So I could see the flags in it. So I called one of my tax advisors and he goes, yeah, let me introduce you to this attorney that defends those programs. And so I talked to this attorney. He goes, yeah, if you want to do it, it's fine. It's not like you're going to go to jail, but just plan on setting aside $300,000 to hire me when eventually it gets, and he's like, you'll hear the story that Mark Zuckerberg did one, but you also hear a story of someone out of Miami that got in trouble for doing one. And it's like, yeah, probably when you have billions of dollars and you're willing to have this legal team defend you, you might be able to do it. But I could see that what they're always doing is pushing the edges of what the law is and taking on the fringes. And I'm like, I'm not willing to do it.
Right.
Because I'd be worried about it.
Right.
But yeah.
Yeah. Well, I think that somewhere in the path of really well before you start making a bunch of money, but somewhere in that path, you have to make a decision about risk assessment in lifestyle
and time
and how you want to live.
Like, look, if you live in California, you may really want to consider a wing or a NING, which is a defective grantor income trust, which says your money that comes in from outside of that state, you could flow through Wyoming or Nevada. You have to pay the highest marginal tax rate, but you don't have to pay state tax on that.
Yeah.
But you have to pay an attorney, and you have to spend time with those attorneys. And it's not just something like, I've looked at them multiple times because Utah state tax is relatively low, but I have clients all over the place, not even that many in Utah. But it wasn't worth the attorney tax, which to me is time I have to talk to an attorney. I'm I'm not inspired by those moments. I'm not feeling, my attorney's pretty funny and everything, but it's not like what I want to do on a regular basis. No. So there's moments like when I just sold my house and it was over the threshold of the $500,000 of gain, but rather than roll it over or rather than try to put it in some special kind of trust, I was like, I'm just going to pay the tax and move on so I can stay focused on other things that are more productive.
Right.
So it's not always the worst thing to pay more in tax unless you're absolutely tipping the government on things that are just right there for the taking, that are just easy to manage and do.
Yeah. I think that those are interesting assessments that people have to make on their own in some capacity. But it's very, very worthwhile. And I know that as life has gone on for me, time is the most valuable thing. Right. And so I actually routinely find myself in a position now where I spend or ignore an expense that, man, my younger self would be so angry with me right now because he couldn't see, past Brad couldn't see the
time.
Vision, the vision of what's here now and the value of the time here now. When I know, hey, if I use that same 4 minutes to deal with this expense,
expand your means, make more money. Yeah, there's things that I just think aren't worth the time to save.
Yeah. Well, so let's talk about a couple. We've let the 831B loom for a while.
Okay.
So when you said you hate defined benefit plans.
Right, because that is purely you have to pay for your employees' insurance whether or not you want to do that or not.
Right. Yeah.
So that's an expense.
That's where I've choked on it in the past.
And then secondarily, you're deferring your taxes. You can put a lot of money. So you're like, oh, I paid so much less tax this year. All you did was you didn't take constructive receipt of your income.
Right. Well, in the idea, of course, is that you let it grow before paying taxes, right?
Right, but here's the thing, and this is what most people don't understand, is if taxes remain equal, meaning 10 years, 20 years, 30 years from now, they're the same tax rate.
Yeah.
Whether you put money in a Roth IRA or traditional IRA, meaning one's after tax and then it grows tax-free, and the other one is pre-tax, grows tax deferred. So hypothetically thinking, it's going to grow to more money, then you pay tax on the back end. They would be the equal amount on the back end because of opportunity cost.
Oh, because
I've run the numbers many, many times. So let's say it's $10,000 on each. Let's say you're in a 25% tax rate. So now you take.
Why would you say that?
Just because it's easier than 37 and a half. And I don't want to upset people when I say 50 with where it's headed to. So
fair enough.
Fair enough. So just simplicity.
Okay.
So you got $7,500 left over to invest in your Roth. The Roth growth, which look, man, people are going to have to find a way into a Roth because they have too much income that we're talking to here today. So you can convert your traditional stuff to a Roth regardless of how much income you have. So there's 4 ways to do that. But now that $7,500 grows to X amount. On the other hand, you can put in the money pre-tax, let it grow for that same amount of time. It'll be a bigger number.
Right.
But you have to pay 25% of the bigger number, which will net the exact same amount.
Because
there's $2,500 that you take out today that would have grown in interest over that time. I agree. The other one grows in interest, but it grows in tax at the same rate that the interest grows. If we pulled out a computer and a calculator, I could show you on a future value calculator. I've studied this stuff forever.
Sure. Okay. So let's put that component aside. You hate defined benefits. And
by the way, we had a client collapse one. It took 19 months to collapse their defined benefit plan.
So that I think is really relevant. You brought this up the other day. When you look at, and like I both want to look at kind of the sweeping rules that help govern these things.
That's why I like a captive way more than I like defined benefit.
Liquidity, right? One is the ability to get out of it if you need to. So the sweeping rule is like, maybe you want something that's more liquid, right? You want a way to reclassify tax, not defer it.
Right.
Right.
Because I think most people would agree taxes are going up.
I would say that certainly in the moment that we're in right now, it seems that that's going to be the case.
Right.
But the problem
taxes are going up or value of money is going down. Pick your poison.
There you go. Yeah. And the problem, of course, is now that seems very evident today in 2021, right? But the problem is making decisions based on our government's future behavior. Man, that's tough.
That's why I like to do more private-based contracts.
Yeah,
I'm a fan of cash value insurance, not as a place to earn my biggest returns, but as a place to store my money with tax advantages that I can use along the way.
Yeah.
Because there'll be opportunity.
Okay, so let's talk about those two things.
Yeah.
So holistically, you're looking at liquidity, reclassification instead of deferment. Those are a couple rules. And reclassification basically means instead of getting taxed as ordinary income at the highest possible rate that you are trying to get taxed at something else.
Which they can absolutely change the rules of an 831B anytime they want, just like they can a 401k, just like they did with 419s and all 412s and all these other tax codes. But you only have to, when you put your money in a captive, you have an 18-month window.
So let's talk about what a captive is first, right? So
it's your own insurance company.
Okay.
That your cash goes into. And you can put up to $2.3 million, I think, into this per year. But then you can manage those funds like an insurance company. So you can't just invest it in what you want. Because if it's not liquid or it has too much volatility, they're going to restrict what you can do with that because it needs to be there in case there's a claim. But again, it's your insurance company. You're not buying an insurance policy like a life insurance or something like that. It's an insurance company. So you have your cash reserves in there that you put in there. You can use reinsurance that says if you have a claim bigger than what you have, there's an insurance, backing that even more than what you've put into it. And so it has an insurance purpose first and foremost. You put your money in pre-tax. So it goes into this account pre-tax. After 18 months, you can take that money out, capital gains. After the first, year's deposits, it's now a 12-month restriction to pull your money out if there wasn't a claim. So we're moving from ordinary income to capital gains, which as of today is an advantage.
Right.
Now, if Biden has his way, he wants to remove that advantage and make long-term capital gains the same as ordinary income.
Right.
Which now we're basically a defined benefit plan.
Which is insanity anyway.
Right. Then it doesn't really have the tax advantages. It's just an advantage of you have resources in case you have an insurance claim.
Yeah. So I'm going to dig in a little bit deeper to that because I want to dig into 831 specifically because 831Bs are scrutinized really heavily.
They are.
And they're also...
You'll double your chance of audit if you do one.
Exactly. And they're also alternate captive insurance alternatives. So cap alt plans that operate very fundamentally the same way. They just aren't 831Bs. But what does it insure for you? So one of the things that pops up when I talk to people about this is and this is also where I think people get in trouble is, do I really want to self-insure? And can I rationalize that? Does it make sense? And the reinsurance is actually a very, very good, not even a footnote. It's a fucking major thing that you have to have over here, right? Because if you're insuring something serious, you need that, right?
I have 10 lines of insurance in my captive. So I did a feasibility study, right? And then it said, what can I insure? And what's the risk that I'm facing? So one was, because I'm not a registered investment advisor anymore, I dropped that license so I could be an author and use the author exemption, and I don't manage assets.
Yeah.
To get bonded as a speaker is a problem because they want me to go get these licenses. My captive provided that for me, so I no longer have to worry about that or deal with that or put up a bond for that or any of that kind of stuff. Reputation management. So if ever I have a type, negative, thing online about me, and it starts to harm my business and I have to defend myself or deal with that, that's a line of insurance I have. So I have these actual lines of insurance. Now I didn't go drop my, business owner policy that protects me that way. I just raised my deductibles so that I can handle these things. Like, so when COVID hit and I had a full slate in 2020 of speaking events, and that's one of the major ways that I make income, and had a really big amount of loss from that, I made a claim on my captive. And so I got money out of my captive. Now, it was my money, but at the same time, that's what the purpose was there for,
right.
Which meant...
You also got it out with no tax, right?
No, I have to pay tax when it's a claim.
You pay ordinary when it's a claim?
Yeah.
Oh, interesting.
Yeah. So I made sure to make the appropriate claim, but wasn't pushing for large amounts of money.
That's hilarious.
Yeah, but I did take a distribution in 2020, which was capital gains.
You're right.
And I have crypto inside of my captive. They allowed for stablecoin.
Oh, right. Staked. You told me that. Yeah.
Right. So that's been kind of cool.
Yeah.
They allowed me to make a down payment on a piece of real estate with a 1-year loan at 2%.
So this is two things. Yeah. So I want to talk, all over the place. I want to talk both. You said they allowed me. So I want to hit on that. And then I want to talk administration of this whole thing.
Yeah, because there's an expense to the administration.
Yeah.
Yeah, that's why you want to make sure you're putting a decent amount of money in
massive,
this.
Right? So let's talk first.
Probably the minimum for a legitimate one's like $2,500 a month.
Administration. Right.
Legal, accounting,
that
kind
you're
of
paying
stuff.
minimum $30,000 a year to administer.
Minimum. Yeah, and the setup fee's twice that amount for the first year. Yeah.
Yeah. So you're looking at, so admin on this stuff, you're looking at 50 to 100 grand setup.
Which defined benefits are terrible that way too.
Similar, right? Yeah. So 50 to 100 grand to set these things up, and then minimum 30 to 50 a year to just have somebody.
Now, if you're putting $2.3 million, not a big deal.
Right. Well, and that gets into.
But you need to have a minimum amount going to this to make it worthwhile.
And what is that number?
The lowest I've seen that works is 300 grand.
Okay. Yep.
That's the lowest I've seen. I've seen people try to do it with 100 grand and skip steps and have crappy firms. And I'm like, when they're audited, they're going to have a problem.
Yeah.
And look, I almost got audited. The thing is, I'm a risk management. Like, I came from that background.
Right.
So my response to the IRS, they dropped the meeting.
Right.
They says, hey, we're inquiring about captives and the abuse of those. And I said, here's my study, 60 pages long. Here's the industry that I'm in. Here's exactly what I've done. I've actually made a claim. And they just said, that's fine. Right. But I've seen people do it. And if they got that letter, they should be worried and concerned, because I had a client that I inherited. He already had a captive under audit. It was one of these offshore captives. He'd been using it to buy real estate, which was not, they weren't going to the insurance commission and asking permission. So if there's a claim, he was completely illiquid. He was building spec homes with it. That's not within an insurance companies aren't out there building spec homes.
Right.
That's not what insurance companies do.
Yeah, right.
Right.
So yeah, that's a lot.
So I only really probably out of per 100 clients I have, one has a captive.
Right.
So I know that we're spending a lot of time on it. But part of the reason I want to spend time on it is because I don't believe in long-term deferral of taxes. Short-term deferral can make sense, especially if you know you have a year where you have a really big windfall, and you can smooth your income with other years if you're not restricting it till 59.5. So income smoothing is a really good tax strategy where maybe someone's selling their business and they don't want to pay that tax all in one year. There's trust where you can spread that out over a couple of years. But if you're spreading that out over 20 years, good luck. Because I'm really concerned for people that are deferring their taxes long term, because from 1944 to 1981, our top bracket was over 50%.
Right.
We spend way more now. I mean, sure, they're just doing quantitative easing to solve it rather than actually tax people.
Yeah. So in one of the things that's interesting, one of the takeaways is this is not unique to the IRS. Humans look for the path of least resistance. It's what we all do in many, 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 many different areas of life. When the IRS is critiquing a mechanism, in this case, it's the 831B, and you come with, okay, you can read through my 60 pages. That is not the path of least resistance. So they just move to the next one. And there's something.
I had a 1-page letter that my attorney approved that I wrote.
And there's something to that, right? It's like, hey, well, this is the gig. This is what we do. And anything that indicates to them, this sounds like this is going to be a pain in the ass, might be enough, might be a barrier. Maybe. Now, I'd say that probably, and you might disagree with this, but probably that's relative to the bracket that you're in, right? If you're making 600 grand or 2 million or 5 million, that's different than if you're making 500 in a year.
Yeah.
Right.
And actually, when not a client, but someone that's asking my advice, that's a billionaire, and said, just give me all the different tax strategies that are out there. I told them, you're pretty high profile. I wouldn't do a captive. I'm like, one, it's just insignificant compared to your wealth, $2.3 million.
Right. And
the last thing you want to do is have like, oh, you evaded tax, even though it wouldn't be true. I just know how the media might work and that kind of stuff. So, there's a little bit of a famous tax that happens with some people, but then there's other people that are just business moguls that go, hey, I'll avoid tax at all costs. And I just have the attorneys. But I just spoke to a group of 20 billionaires, and the guy that put on the event said most of these guys, their accounting, their tax strategy and tax attorney bill is 7 figures a year.
That's crazy.
But he goes, at the same time, they're saving
totally worth it.
So much money, it's worth it. But I think relative, we have to think like, what if I get an account for $1,000 or I get one for $5,000? But the one at $5,000, really a tax strategist, navigates all this kind of stuff and saves me $70,000. Like that's the mode of thinking I think people should be in, right? And I want someone who's efficient and effective. I don't want to be having them sit there and think about it out loud for 30 minutes while I'm on the phone.
Right.
I want to present some things and have them tell me why it would work or why it wouldn't work and whether they'd put their stamp on it. And again, I think it needs to be moral and ethical. Regardless of how I feel about where my tax dollars are going, I still want to make sure that I'm above board with all of it because I don't want to invite a fight.
So go with a 60-year-old, not a 30-year-old for a tax strategist?
I don't know. I mean, your entrepreneur or your wealth strategist could be crazy as hell, but just make sure you have someone that, is really thinking through how this would be impacting and if they've handled audits.
Yeah. Well, that's why I say the 60 instead of the 30, right? The 60-year-old has had a lot more time.
I just don't want the 60-year-old to say, I'm super conservative, because that really usually means, hey, you're going to overpay tax, and I told you so that I was conservative. I'm like, well, I want someone who's ethically aggressive. I don't want to go to court.
Yeah.
I don't want to have a big issue, but I want to do everything within our rights and power to save on tax as long as it doesn't take too much time.
Yeah, I love that. Okay, well, I'm hungry and I want to eat food.
Let's go eat food.
But I want you to give us one other. So like the other thing that pops up all the time is, and you mentioned it, but is universal versus whole life and where that fits into your world and what the purpose is, right? So people, this is one of the first things that got introduced to me when I moved into the bracket where really it was where people were like, ooh,
we want to sell you things.
Yes, we want to sell you things.
Give you money for us to make commissions on.
And the commissions are absurd. The commissions are so big. And all of these, high net.
Especially when I first started being a life insurance agent, I was designing it straight commission. My first few years, I didn't know any better, So, it's less likely to happen these days. I feel like you're getting a lot more educated insurance professionals out there. I actually feel like I deserve a small amount of credit for that with some of the books I've written.
No, 100%.
But
so just where does it fit in general? Like overarching.
I have 27 insurance policies. That includes policies on my wife, my kids, business partners. And my first ones were $50 a month, $250. So I grew, but only one of them is an indexed universal life policy. Personally, those are oversold because they illustrate well, but they illustrate well on the non-guaranteed side. They illustrate horribly on the guaranteed side. So you have to ask, why do you have this policy? I have whole life policies because I want stability and access. When I'm now chasing a return, they have levers they can move based upon risk management factors like M&E expense, which is your mortality and the experience of how many people die per 1,000 bundled in that policy. And as you get older, your cost of insurance go up, but they're hidden on the illustration because you haven't touched your cash value. When you touch your cash value, they run on net amount of risk. So it's your cash value and your death benefit. They subtract the difference and say that's your net amount of risk. Well, that looks great, illustrates great. But in reality, there are no deals in insurance. And I feel like the cost of insurance inside of most indexed policies, It makes it look good up front, but there's surrender charges unless you're really wealthy. And then they can get them without surrender charges. I've done some of those before in strategy, handing people over. But I look at the long-term performance and the guarantees. I want access to my cash without creating a lack of guarantee to the cost of insurance. And so it might not illustrate as well, but I think the economic value of certainty is worth it for a lower illustration that I think has a higher likelihood of sustaining at a guaranteed level. And I want my death benefit, no matter what, to be around the day after I'm dead, because I actually use it to increase cash flow with other assets.
Yeah. So somebody that hasn't looked into index universal or whole life doesn't have any idea what the fuck
they just said, what is that foreign language that you just used? They should read What Would Billionaires Do? It's really simple language that I wrote.
Well, but just for clarity, when you talk about guaranteed versus non-guaranteed, it's basically the whole structure of the policy is guaranteed if you have a guaranteed policy.
Yeah, whole life will be guaranteed premium, guaranteed minimum interest rate, guaranteed insurance cost, and guaranteed death benefit. If you move to universal life, it's built upon a term insurance chassis, which means your cost of insurance goes up over time. So it's going to look a little bit better up front. And it also could be tied to the performance of the stock market, which has done well for a while.
Hence indexed.
Indexed to that, but capped, or a margin fee that you get subtracted, not like buying on margin, but the difference between what was actually earned and what you get there'll be a subtraction of that kind of takes care of things. So that may look really good, but you're guaranteed not on your interest rate, you're guaranteed a range of interest, right? So you do have a guaranteed minimum in indexed. It could be 0, it could be 1, 2, 3%, depends. Your premium is guaranteed for now, but as time goes on, if your cash value doesn't do what it's supposed to, or the cost of insurance goes up, your premium could go up. So you can put riders on there that say, oh no, this is guaranteed. But if you miss a payment or use the cash, you might negate the rider. So I'm going, why would I put potential? Like I had a cash flow crunch in 2008. I missed payments on my whole life policy that would have negated the whole thing. So the reason I have an index universal life policy is there's something called premium finance, where they will have a bank lend me money and interest rates are really low. And I can put it in the policy, which right now I've done better than what I'm paying for use of the bank's money. So I'm arbitraging like a bank does to everybody every day. I'm saying I'm paying less for access to money and earning more. And that's a year-to-year analysis for me. So I go, how did it do this year? Do I want to continue it? And then I make that decision. I don't want that as a death benefit 40 years from now. I look at it as a one or the other with universal life. Is it a cash play or death benefit play? If I touch my cash, it might negate my death benefit. If I don't touch my cash, I know the death benefit's going to be there, but now I don't get that same use. So I'm looking for safety, stability, because cash value is not my game. It's my storage shed for my middle term money, because I'm doing better than savings accounts and money markets and those kind of things. And I have access to that cash. And if the market goes down, my cash is still earning interest. And that's the time I'm going to want access to that cash, is when things go down. So I don't want to tie that to what's happening in a stock market I don't believe in.
I like it. And for clarity for anybody,
I wrote a really good article in Forbes about it, by the way.
Did you?
Interviewed this guy that's like a software guy that built an entire thing called Truth Concepts by the name of Todd Legford. And it's the 10 risks of index universal life insurance. And a lot of people sell them like, it's like the same thing, but index universal life does better. Okay.
Right.
They just haven't been around long enough to know the first universal life policies built by Penn Mutual imploded. Because more people started to die 30 years down the road than originally planned. The cost of insurance started to go up. And if anyone was healthy, they just go to a new policy with a new company. Anyone that wasn't healthy was stuck with that. And the cost of insurance eventually went up so high, it ate up all the cash value. And now they had to either pay more premium or cancel the policy.
We'll link to it. We'll find it and link to it.
Yeah, it's good. It's a good article.
Well, I think but one of the reasons that it's so important for people to have guidance is because many of, like, specifically when you get into this kind of policy, you're looking at, the risk assessment table on the back end, and more accurately, you're not looking at it. And so you don't know what's going on.
Because how do you know what to ask?
You don't know. You don't know what's going on. And what you do know, if you look at these bigger policies, is the premiums are crazy. Like, they're intense. You're looking at, 6 figures plus a year paying into these things. And you, like you said, you have to make sure you structure them the right way so that if you mess something up, you don't just lose the whole thing.
Right. And it's crazy because there's even whole life policies where you can have like 94% of your cash in the first year versus one that might have like 75% of the cash in the first year. Mm-hmm. But if you look in the 10th year, the one that had more cash up front is underperforming 10 years down the road than the way the other one's structured. So there's all these little stupid nuances.
Yeah.
And it just so happened that when I was 18 years old, I bought a variable universal life policy, which is a universal life tied to the stock market because that was the 90s. The stock market was just going up and up. And someone illegally showed me 18% a year, saying that was conservative, which meant off $70 a month, I was going to be a multimillionaire 30 years down the road from just $70 a month.
Yeah.
Didn't happen. I was in school taking an econometrics course, did my thesis on the variability of that policy and the viability of it, and ran all these things called Monte Carlo simulations. And I got an A in that class for showing there was a 98.6% chance the way it was funded, it wouldn't be around in 30 years, let alone there was no chance, no statistical relevance over a 30-year period of time for that policy to survive under the variables. But that's what was being sold because these people are selling something they don't understand.
And they're doing it because the commissions are egregious.
Right. And because it illustrates well.
Yeah. They're huge.
If I draw a huge number on a board and say, do you want this number? You're like, great. It doesn't mean I can provide that damn number. Right. And that's unfortunately what was happening. Just invest in your business, save on tax, and store it in a place that's stable. That's a really simple, straightforward plan. You don't have to listen to all the noise. You don't have to feel overwhelmed. You don't have to get good at everything. You don't have to own real estate to be wealthy, even though that's what people say all the time. You don't have to go learn about tax liens and options trading and hard money lending, and like stick to a lane that you're really good at and don't diversify into things you know nothing about, because that's diversification. And if you haven't fully funded your business and got your cash flow where it needs to be, why go invest in other people's businesses you know nothing about? Build that up, save on tax, capture that money in a place that's a little bit safe and secure, build up some liquidity, and then wait for good opportunities. And when they come, pounce on them. Be patient for years if you have to.
Love it. Always good talking, man.
And stay away from Dogecoin. The Doge.
We could talk about all of these in great detail, but we're going to go explore Austin, get some food.
Awesome.
I'm glad you're in town. So
it's good to see you, bro.
Always good to see you, man. Appreciate you having me here. Appreciate you having me here. So what I just said.
If you learned one thing on this episode, share it with another entrepreneur. They need to hear it. Also subscribe so that new episodes just show up on your phone. It's a lot easier that way. And if you want the really good stuff, check out our free BAM! Tactics and Strategies course. It's where we curate the best tips, tricks, and tools that our guests know, whether they've shared them on the podcast or not. Just go to beyondamill.com. You'll also find previous episodes and show notes at beyondamill.com.